Everyone, clients and friends of Schneider Wealth Management Advisors, it is my pleasure to bring the first of what we hope are many conversations with some of our trusted investment managers and strategists that we consult as we consider allocating our clients' assets. And today we are very fortunate to have the Chief Investment Officer of Versus Capital, Casey Frazier, here to talk about real assets. And I think it's kind of a timely discussion given the volatility that we've seen in the stock and bond market. And here at Schneider, one of the core foundational principles of our investment philosophy is that much like how life is not black and white, neither is investing. We think that there's more to client portfolios than just stocks and bonds. And so really excited to have Casey with us. So Casey, welcome. And to get this started, I figured, let's just kind of start at the beginning. So when you and your colleagues and founders decided, 10 plus years ago to found Versus Capital, what were you looking to add to the RIA marketplace? And specifically, what did you think was going to appeal to people like me and to our clients about real assets?
Yeah, well, first and foremost, thanks, Jason, for having us on. I do think this is a really timely discussion as we're all facing a world that looks and feels different than some of the last beginning of the year. So when we launched this business, over a decade ago, we were really trying to figure out the most optimal way to get high net worth investors access to this really great asset class that just really hadn't been available to them before. We had built our careers trying to find the right solution, and frankly, we had kind of run some great businesses along the way, but they just weren't the most optimal solution. And that we wanted to find a way to bring private hard assets, which had been our background, to run by institutional investors, because these are very complex investments in a lot of ways. They're hard to access. And we wanted to bring that in a way that was actionable by RIAs and clients like Schneider. And so that's a tall order. No one had ever really figured it out yet. And so we spent a lot of time and a lot of tough discussions and going down the wrong path until we kind of finished our research and found that there was a solution, which is called an interval fund. And it did allow the access to putting private assets along with some public assets, because there is liquidity needed in that vehicle, but put it in a wrapper that was very similar to a mutual fund. And so that the access point could then be created to provide high quality institutional managers within a structure that could be implemented without a lot of the challenges that private real asset investing had had before.
Yeah, and I think that was so interesting to us as we were beginning to think about this idea of real assets and incorporating it into client accounts. And I think as we delve a little bit deeper into kind of the real assets that Versus helps clients get access to, right? So you think about high quality commercial real estate, farmland, timberland, infrastructure. As my firm, as Schneider was doing our due diligence, there are some common themes that link them all together, which I think is intuitive and I'm sure you're going to kind of get into why that is intuitive, that there are some common linkages between all of them. But what I found to be very interesting, and where I think that this concept of real assets in a portfolio works really well, is that when you in a vacuum, there are a lot of things that link them together, but they're not really correlated to one another. Real estate to timber to farmland to infrastructure. And I thought for sure kind of timber and real estate, certainly those I thought would go hand in hand, but they're really, the correlation is not nearly as high as you would think. And that kind of makes part of the reason that the secret sauce works, if you will. So can you talk about how you think about constructing portfolios at a high level, and why these four forms of real assets, hard assets, as you said, makes so much sense, especially given the times we find ourselves in now.
Yeah, absolutely. And real assets can mean a lot of things to a lot of people. And so for us at Versus Capital, we really think of a couple of defining characteristics, and then that puts you into the four buckets that we invest in. So what are those characteristics? What are those similarities that you brought up? One, they're tangible in nature. So we're not out speculating on the future prices of an underlying commodity like timber or corn. We would rather own the land, the tangible asset that is really key into delivering that asset. And so tangible assets is a common theme, that they are backed by contractual cash flows, and those cash flows are durable over time. So we would rather own an asset with a contractual cash flow and have a tenant pay us that cash flow over time. It makes that very stable. And a lot of times, these areas that we focus on, those contractual cash flows have linkages to inflation, or they have some way that as inflation makes its way into the market, they're able to pass that through into those contracts. So that's another key defining characteristic. So tangible assets, contractual cash flows, sensitivities to inflation in a good way, and then that low correlation to traditional markets, so equities and fixed income. The bonus benefit that you really honed in on is that these asset classes historically have low correlations to each other, so that when you combine them into one portfolio, you get outsized benefits. So when you always think about the old definition of correlation and how that works, it's when one of them is zigging, the other is zagging. Well, the nice thing about these assets, that works really well. They have low correlations to each other. And so we can optimize, and our clients can optimize their portfolio by blending private infrastructure, private real estate, private farmland, and timberland all into one portfolio. And then you even get those benefits, much like you do with the rest of your portfolio, adding diversification.
Yeah, and I think that idea of like diversification and lowering correlations of asset classes, I think that from time to time investors do get reminded that when volatility spikes, right, you whether you own junk bonds or U.S. large cap stocks or emerging market stocks, when there's a lot of volatility, correlations tend to get closer to one. And I've always thought that there was a better way to increase, increase diversification and lower correlations, within portfolios, which kind of brought us to this idea of real assets. And as you look out, and as you said, you and your colleagues had successful careers prior to founding Versus in 2010. As you think about this evolution of the 60-40 portfolio, and for us, we always show clients, we kind of show the peak of the 10-year treasury in 1980, right? And then it just kind of, there's this glide path that goes all the way down from something like 16% to as low as 32 basis points during COVID. Bonds are a seesaw, right? Prices go up, yields go down. That's really good if you're a bondholder. Well, we're kind of on the back end of that now. And as you have evolved as an allocator and as an investor in real assets, can you talk about kind of pull on that thread of diversification a little bit more in this idea of a stock bond portfolio, and how real assets is just at a high level, like you're showing here, can add not only diversification benefits, but also potential differentiated return streams into a portfolio as well?
Yeah, absolutely. So when we think about these times of volatile equity and fixed income returns, the old philosophy was, that bonds would be that ballast in portfolios. Well, as you mentioned, in a secular down environment of interest rates, that works okay. But as we've gotten to a point where rates are extremely low, and you've had to move out to try to find yield throughout the market, you come into a different situation where you're taking on different types of risk. And so when we see volatility, like we've seen in the first couple of months of 2022, where you have interest rates increasing, along with some political instability or challenging environments in the equity markets, those two move in tandem. So when we think about our portfolio and the diversification benefits of it, it's just that we are using in the underlying asset classes that we're focused on, especially tilting towards the private side, we are less influenced by what's happening in the public markets. We own long-dated assets that have contractual obligations or contractual cash flows, and so they create inherent stability within that portfolio, and the drivers of those returns are different than what drives the equity markets. So, for example, in our farmland portfolio, even in environments where you're entering into a recession or a business cycle challenge, food consumption, because of population growth, goes up. And so we have just a different driver of return than what you're getting in your equity portfolio. So we can do that through a ton of different examples, but those are the reasons why these underlying asset classes perform differently in environments, and why adding them to multi-asset portfolios, like we highlight here, can be additive to that and help you and your clients create more efficient portfolios, in our opinion.
Yeah, and I think that it's really interesting too, because it used to be, obviously, when we entered into the COVID pandemic, it was like, what is this going to be? Is this the plague? Like, is this the end of days? March and April, you don't really know much about the disease and kind of the virus and how that's going to shake out. Now, when we're having our client conversations, it's about inflation. And I think for some of our clients that are, that remember what it was like in the late 70s and the 80s, it's a harsh reminder of what that can do, losing the purchasing power of every dollar that you make. And I think for some of our clients that are maybe, weren't as personally affected, either because, they weren't young enough, or for some of our clients, they weren't even born yet in the late 70s and the early 80s. And we're trying to talk to them about inflation and what, President Reagan and Chairman of the Federal Reserve, Paul Volcker, did to break inflation. But it's the number one topic. And obviously there's a lot of volatility geopolitically going on with Ukraine. And Ukraine's the number 5 wheat exporter in the world. So it's, when you take those two examples together, when we're, those are the two kind of top of mind, I guess, right now for most of our clients. Maybe walk us through an example of how, whether it's infrastructure, farmland, timberland, or high quality commercial real estate, how those assets benefit, right, from not only the long dated contractual cash flows that may or may not have inflation adjusters to it, but how just a physical real asset appreciates as inflation goes up.
Sure. Yeah, I mean, as I mentioned earlier, having inflation sensitivity in a positive way is a key characteristic of all 4 of these sub-asset classes that we invest in. And they all react differently in different time periods. So as you can see in this chart that's behind us on the screen here, timberland is the most reflexive to inflationary time periods historically. And we can talk about some of the reasons why. And real estate is also really reflexive. And so when I think about those common characteristics in those contractual cash flows that you and I talked about earlier, and how that reacts in an inflationary environment, as inflation enters into the system, someone is paying. And I think that you're a student saying, man, it's really different environment, and people feel it in different ways. Do they feel it in their investment portfolio where they're looking at returns that are different than they would have expected? Do they feel it in their pocketbook when they go to the grocery store or when they're filling up their gas tank? Well, now where we're in an environment where inflation has been persistent for a period of time, I think they're feeling it in a lot of ways. And that's why it's a topic that is conversational in a lot of with a lot of clients, and we're feeling the same thing. I think the key for us, and I'll do it in a couple of examples, it is probably the best way to do it, is just to think about how inflation makes its way into a couple of these sectors. So let's think about real estate. So you have a piece of real estate, you have contractual cash flows, and the key is, how do you get more cash when things are getting more expensive. And one of the ways is through, Jason already mentioned this, having leases that are tied to changes in inflation. So we have a lot of leases in our portfolio that if CPI goes up 4, the lease rate that our underlying tenants pay us goes up 4 as well. So that's great. We also then, as inflation makes its way into those rents, a portion of our leases roll in any given year. So we get the ability to raise those leases to market, and in inflationary time periods, rents are going up. I'm sure your clients feel this in their multifamily, right? If they're an apartment renter and their lease rolled over in any time in the last 12 months, that landlord asked them for much more rent than they were paying before, most likely. And so that's good. As cash flows are going up, our buying power is trying to keep pace with that CPI, and historically that's been the case. Additionally, and I think this is the thing that is not as intuitive, when people start to get concerned about inflation, more capital looks for sources that have growing incomes and that do well in inflationary time periods. And so we saw this in 2021, it was a record year from transaction volume in the real estate market, and returns were very, very strong. Well, people are concerned about inflation. They're looking for places that have inflation hedging potential, so they put more capital there, which then drives valuations up. So it comes in two parts, both income growth and appreciation. And I'll just add the final thing in real estate. When you own a portfolio of real estate, one of the gauges of value is replacement cost. So when replacement cost goes up, and we're in a period where construction costs are up 30 to 60%, building a new building to compete with the building that I own gets more and more expensive. And so that limits the amount of supply coming on into the market. And so that's another good factor for real estate owners in an inflationary environment. The same thing holds true in farmland. So as the goods, services in the market go up in value, farmers make more money. We're able to increase the rent that they pay us. And then there's more capital in the market searching for those farmland assets, so values go up as well. So it's the same concept. It just happens a little bit differently in each of the verticals.
And so that's, I think, that was a really interesting, kind of way to put it. And it kind of goes back to that initial topic that we kind of talked about, which is that there are some common linkages between all 4 of these individual kind of subsectors of real assets, but they're very differentiated in the way that they earn rates of return and how inflation affects them. And I think that that's the reason we've always advocated, you kind of have to own all 4, because you never know which one's going to do better, right? You kind of own all 4, you get that diversification benefit. They're not really correlated to one another. I keep thinking back to a timber manager. It's like, well, how did you earn a positive rate of return in 2008 when everything else was negative? He's like, he looked at me and was like, well, the trees kept growing. I'm like, yeah, I mean, that's true. Trees do keep growing. So there are kind of ebbs and flows to these asset classes, but they really do provide a different risk return profile than a traditional stock and bond portfolio. And I think from a real estate perspective, one of the things that, I'm sitting here in my office here in Pittsburgh, you guys are in your office here taping in Denver, we're back in the office. 12 months ago, Casey, I was told that office was dead. No one was coming back, and we were going to work from our homes. For everybody that took a call with me, I was in my bunker basement. That my wife was absolutely mortified that I would take Zoom calls on there and actually show the background. So I'm happy to be back in the office. My wife, Britt, is certainly happy to have me back in the office. But can you talk about maybe the death of office being overdone for maybe, the 7th or 8th time in the last 20 years?
Sure. Yeah. It's been an interesting ride in the office market and in real estate in general, right? With the uncertainty of 2020, with the strong rebound in 2021. And we'll talk about each of the subsectors and really dig into office here. But I think in general, the theme is real estate transaction volumes were up significantly. Why does this matter? It goes back to our earlier discussion about transaction volumes at their peak mean that more and more capital is seeking a finite group of assets in this sector, and we would expect this to continue into 2022. The interesting thing is, in addition to everyone saying office is dead, everyone also was saying that the major metro markets were going to be dead. Well, we're certainly not seeing that. When we look at the transaction volume in 2021, it's still a lot of the big markets that we've seen in the past: Los Angeles, New York, Dallas, Fort Worth area, San Francisco, Atlanta. You see Boston in there, you see DC. So investors with their dollars are saying, hey, maybe the office market isn't dead. And you know what, maybe transactions in these major metro markets are dead. And so we do see that there's that the market in real estate has rebounded. It's coming back into an expansionary phase, and there is a lot of capital coming into this market.
So, when you talk about office, Casey, can you maybe explain kind of what you're hearing from from the people that you consult, both at a macro level and to the extent that you have, you've had conversations with some individual portfolio managers about how they're seeing both kind of CEOs of companies bringing people back, but just kind of broader conversations they're having with their tenants as we learn to live in this kind of new normal, which is like, I guess everybody's throwing out that term hybrid. Kind of elaborate on whatever it is that hybrid means to you and what hybrid means to the portfolio managers that you talk to.
Sure. Well, I'll just point to a couple high-level statistics in here, and we have a couple of charts that are in the background. One, leasing velocity is up, and we're starting to see, as people are starting to come back into the office, that people are saying, hey, not only do I want my people back in the office, it may be 3 days a week, it may be 4, it may be 5, depending on the company. Now I want my people coming back into an environment that they want to come back to. And I think what we're really seeing with occupancy starting to turn and go the other way, which has happened much quicker than most people predicted, is that there's going to be a large bifurcation in the market. So if you own the best assets in the best markets, there's already increasing asking rents, there's already occupancy gains that are happening. And so people are going to consume office differently, which creates an opportunity for some. But anytime you create opportunity for some, you create a challenge for others. So I do think work from home is going to have a dampening effect on the demand for office over the next decade. That's nothing new. We've known that this was an option. It was accelerated by COVID. But what I think happens, in my personal view and the view of a number of our managers who own this asset class for decades and run it on a day in basis, is it's going to push real winners and losers in this sector. So if you own commoditized office, think suburban office in markets that is older product, or even in major metro markets that is older product, I think it's going to be a challenging environment. So I think there's going to be a big bifurcation, longer term trends for office, new job growth coming online is very positive for the sector. So, and the way we consume office, like the ones we're sitting in today, we're taking more square footage per user and a lot of things that I think will dampen the effect of work from home, especially if you own the right assets. The other factor is that we're seeing a decrease in supply coming in. So as we see that decrease in new supply, that will also help that existing stock that's in there if you have the right assets.
Yeah, I think as I look out kind of at the skyline of downtown Pittsburgh, it would be incredibly hard to build a new office tower here. I just don't know where you would even put it. And I think to that point is as long as you're identifying kind of these growing metro areas, that it's kind of, you run into issues like Pittsburgh, right? To your point, it's like, where are you going to build it? The replacement cost comes in, and if you own really good assets in a really good neighborhood, that's always going to end up being a good place to be, is kind of the way that I think about office as we enter kind of 2022. I think next, really just it's interesting because President Biden last night in his State of the Union, it seemed to try to sort of try to get a part of his agenda that was kind of rejected in November of 2021, kind of the larger stimulative bill fiscal package that he had that I, Senator Manchin from West Virginia kind of put the death knell in November. But the infrastructure package that he did pass, that his administration did pass, early in the fall of 2021, he didn't necessarily talk about all that much. But I think that you see that $1 trillion number, and I always think about, when you hear the word trillion, literally write the number out. It's a very big number, right? There's a lot of zeros there. I sometimes think our congressmen, our elected officials couldn't write it out, but they're, I think writing it out shows you how big of an actual, how big $1 trillion is. But that's kind of a drop in the bucket to what we actually need to spend as a global community to make sure that our infrastructure not only just keeps up with just the wear and tear, but really meets our needs in the future. Can you hit on some of those topics?
Yeah, I'm with you. When you start getting into the trillions, it gets larger than you can digest. But let's try to break that into a number here and think about what some of those sectors are and what does it look like. This is a chart that shows that just over the next few decades, we need about $3.7 trillion annually to keep up with the infrastructure funding needs of the global economy. And when we think about all of the capital that has already been spent and the balance sheets of our global economy, when you think about the central banks across the globe, they don't have this capital anymore. So it does have to be some combination of private capital involved. And so your point is right on. We're trying to figure out how we do fiscal stimulus that encourages some capital from the government along with private capital to solve this need. And this is a massive need. We think we're at the beginning of an infrastructure super cycle, and you can break that out into these pieces, right? We need more transportation assets. So we obviously have seen a lot of news about how our ports aren't being run efficient enough, and that's causing delays. So guess what? We need more. We need more advancement. We need more CapEx into those ports. We need more capital spent on airports, rail and our roads. And that's $1 trillion+ of spending annually. We obviously know that there's going to be a change in how we consume energy going forward. And there's a huge opportunity in that's renewables. It's how do we get more clean energy into the world. So these opportunities, and water is obviously another huge one, and that doesn't even touch on what we need from a digital infrastructure or communication standpoint. So it's a massive need. We need a lot of capital coming into this, and we need partnerships with both private and public institutions, in my opinion.
Yeah, and I think that when for our clients out there, and friends of the firm, I think a good way to think about this is, at one point last year, 25% of all dollars in circulation were printed during the year 2020 to get us out of COVID. We put a lot of debt on the balance sheet, not only of the United States government, which, the national debt's over $30 trillion, but also the European Central Bank, the Japanese Central Bank, all of these countries, did what they thought that they had to do to get us out of COVID. And that just crippled already impaired balance sheets. So I think the way to look forward is that we were going to have a hard time meeting these needs prior to COVID happening. And then COVID just made every government's balance sheet that much worse. Moving into, so we talked about real estate. We talked about infrastructure. I just went to the grocery store today. I bought about 10 things and it was like $140. It's just, you feel it, and it wasn't even Whole Foods. Shout out to Giant Eagle, which is a dominant and wonderful grocery chain here in Western Pennsylvania, and up where I grew up in Northeast Ohio. But I mean, it's expensive, and we're seeing that, we're feeling that. Farmland is one of those, interesting asset classes where I think it's really misunderstood. From a finite standpoint, God only gave us so much of it, right? There's only so much land that you can farm, especially with the way that we've, our kind of urban sprawl, right? We've even taken some of that out. But can you just talk about the opportunity that you're seeing in farmland, and how maybe that has, if it's changed from when you started investing and when you founded Versus, and what the opportunity set looks like going forward as farmland kind of truly enters the 21st century as an investable asset class?
Sure. Yeah. So when we think about commodity pricing, when we started this fund, we were at cyclical lows, right? And that's a good time to be investing and buying assets and striking deals. But it's a challenging time as well, right? As commodity pricing goes against you, you want your farmland partners. We lease all of our farmland. We want our farmland partners to be solvent. We want them to be thriving, and rents either stay flat or they can go down in that environment. Prices reflect that. So, when we think about that on a go-forward basis, 2021 was a very good year for our farming partners. Net farm income was up almost 25%. And that is a good thing, because then as we get to those leases, we can ask those farmers to pay more. As our land goes up for sale, there are more bidders. And so that inflationary pressure that you're feeling in your pocketbook at the store, a lot of that accrues to the farmer in the shorter time frame. But if commodity prices are up over periods of time, that makes its way into our portfolio. So at least we can get some of that hedge and that inflation protection within getting to those rents and increasing those rents. We also oftentimes have some flex rent in our leases so that when prices go up, we get some benefit to that in addition to the farmers getting all of that benefit.
Mm-hmm. Yeah, it's certainly, I think from that farmland perspective, it's been at a very high level, I was able to understand kind of why you'd want that in a portfolio, but it's been very good to see that kind of just be so steady. And to your point, coming off, the lows in 2010 to kind of where we find ourselves now. And, timber, I guess I go back to that first quote. When I was talking to the timber manager, how they managed to make money in 2008, as if I haven't been on this earth for 39 years and seen trees grow. But I'll always take that with me. It's like, yeah, trees keep growing. That's one value of timber. One of the things we also learned in 2021 is that it is incredibly hard to trade lumber futures. And as the good folks at Bloomberg and CNBC kind of discussed, there was this wild and crazy run up in lumber futures, and you're kind of like, that seems to be a pretty niche asset class to be covered by CNBC and Bloomberg. Some people made money, a lot of people lost money. Can you maybe talk about one, the value of trees keep growing, kind of why that's a valuable thing to have in an asset class, and how timber is a lot different than playing in the futures market, trading lumber futures? Yeah,
absolutely. It goes back to our fundamental belief that you want to own the land and not speculate in the commodity, because as you can see in this chart, that was a wild ride. But what kicked off the wild ride is underlying fundamentals that will drive the performance of timber, not just lumber, going forward. And when we think about that, what is that? That's housing starts in the United States. The demand for lumber has started to increase during 2020, which was a little bit of a surprise to many, as people were saying, "Oh, we're losing jobs and other things are happening." But we're fundamentally undersupplied from a housing standpoint. We're short 6 million homes. And even in good years like 2021, where we were a little bit over 1.5 million new housing starts, that means we still have 3 or 4 more years, and it's compounding on itself. With a full economy, we have people coming out of college and are in the renter pool and housing. They're coming out and getting their own houses. They're coming out and they're renting multifamily units. We have all of the millennials who went back to their houses with their parents are now wanting to get back out on their own. And so a full economy really spurns that demand. And so as housing starts go, lumber prices and ultimately saw timber prices, which is what matters for timber owners, those start to go in the same direction. And so while there's a lot of speculation in the commodity, the underlying demand drivers for the end product will make its way into the underlying timber itself.
No, it certainly was, and I remember thinking to myself, like, just the whole lumber futures thing, that was one of those kind of, I feel like we're gonna, whether it's Dogecoin and some of these crypto assets and kind of random coins that go up and people thinking that they can trade lumber futures. So I guess I kind of want to end this with I guess somewhat of an open-ended question, which is, you've been investing in real assets for over 2 decades. You've seen a lot. Certainly, some of the more highly publicized fallouts from some of the endowments getting into timber and farmland and kind of levering that up in 2007 and 2008 to nobody wanting to own it for quite a long period of time. Real estate's going up, real estate going down. As you look forward, as these asset classes really mature, and I know we have data going back to the 90s, but as you've now been helping RIAs like Schneider Downs get access to institutional quality real assets, what do you think the future looks like? And what is the from an availability to continue to get a high quality exposure, what's kind of talk about what you see as the future of real asset investing as we get through 2022 and beyond.
Sure. Well, I think this is a really interesting environment for what we do. We have built this business to provide exposure to these different subsectors that we think are extremely well positioned today. But we also think that ebbs and flows over time, and that inflation is a concern today. But you don't want to build a portfolio of assets that only does well if CPI is greater than 4. So we like the boring nature of our assets. We think if you can hold tangible assets, contractual cash flows, do that with smart operators and good operators, that over full market cycles, you'll have a very steady and stable ballast in a portfolio. What we see for the overall asset class, we see increased adoption, whether that's on the institutional side in foundation endowments and large institutions who have been steadily increasing their exposure to real assets over the last 2 decades, or whether that's in the high worth market through RIAs and others who are looking for other sources of return and differentiating types of investments. So overall, we think that this is a good time to invest in these asset classes. But we also thought it was a good time to invest in these asset classes 5 and 10 years ago. It was just having that access and those mechanisms. And really, we think that overall allocations to these asset classes will continue to increase. And that's largely on the back of understanding that there is a challenging environment for our clients and clients across the world with a big portion of their portfolio being tough in the fixed income market.
Yeah, I mean, I think our clients have certainly enjoyed kind of the quote unquote boring nature, certainly kind of in those high stress periods. Certainly we found ourselves in COVID and sometimes that we certainly find ourselves in now. I just want to take a minute. Casey, thank you. You've been a wonderful partner to Schneider Downs, you and the entire crew over there at Versus Capital in Denver. Really appreciate you. Couldn't think of a better person and better firm to kick this series off with. So thank you again for joining us. Have a good rest of your day and look forward to continuing the conversation down the road.
Yeah, well, thanks. We appreciate the partnership and look forward to further discussions down the road. Thanks a lot.